Capital moves globally at speeds and scales that defy individual control. Billions of dollars shift across borders in fractions of a second based on algorithms, macroeconomic data, and institutional decisions. This comparative bar chart looks at long-term institutional commitments, specifically Alphabet's July SEC filing. The company is allocating a massive $205 billion toward artificial intelligence capital expenditures for 2026. To put that expenditure in perspective, Alphabet's entire full-year 2025 revenue was $307 billion. This line chart tracks weekly Bitcoin ETF flows, showing rapidly fracturing short-term sentiment. After a steady climb, the final 48 hours saw $465 million exit the funds. Despite that, overall weekly flow held in net positive territory, finishing at $333.79 million. These global markets operate in billions and pivot in hours. Retail investors navigate an environment entirely governed by external, unpredictable forces. Beyond price volatility, the actual regulatory frameworks governing emerging asset classes remain highly fluid. On July 23rd, CoinDesk confirmed that the U.S. Clarity Act missed its summer legislative window. The missed deadline leaves a foundational question unanswered: whether crypto tokens are classified as securities or commodities. This leaves cross-border compliance for U.S. 401k plans and Canadian RRSP and TFSA accounts in regulatory limbo. Regulatory decisions create immediate financial impacts. On July 24th, the SEC approved staking inside U.S. spot Ethereum ETFs. BlackRock's ETHA now pays a 3.8% annual yield to its shareholders. Canadian holders of non-staking equivalent ETFs are currently forced to forgo that 3.8% yield due to cross-border disparities. There are also looming technological deadlines. Google researchers recently cut the projected timeline for securing legacy Bitcoin addresses by 95%. The migration window to move older Bitcoin addresses to post-quantum security standards now abruptly closes around 2029. With emerging asset classes defined by missing regulations, border disparities, and shifting technology windows, investors must seek stability elsewhere. That stability exists in the strict domestic certainty of the Canadian retirement system. The figures involved here are matters of educational arithmetic, not guarantees, but they obey rigid rules. Deferring the Canada Pension Plan to age 70 permanently increases the benefit by 42%. That specific option vanishes entirely the moment an individual turns 70. This chart compares actual CPP payouts at age 65. The average payment is $925.35 per month for January 2026. The maximum is $1,507.65. Illustrating this deferral shows a gap of roughly $341 per month. Understanding this pension arithmetic provides an absolute predictable baseline, entirely separate from ETF flows or regulatory debates. Retirement accounts also operate on strict age deadlines. Converting an RRSP to a RRIF is mathematically mandatory by age 71. At age 72, the mandatory minimum withdrawal rate is rigidly set at 5.40%. On a $200,000 RRIF, that 5.40% minimum forces out $10,800 of taxable income, whether needed or not. That forced income triggers a chain reaction, reducing the guaranteed income supplement by 50 cents per dollar for those receiving it. The old age security recovery tax threshold is strictly set at $93,454 for the July 2026 to June 2027 period. Above that line, 15 cents of OAS is repaid per dollar of income. This gauge visualizes a worked example, resulting in a $6,900 per year clawback cost. However, the absolute maximum clawback can mathematically never exceed $9,024 for ages 65 to 74, or $9,926 for ages 75 and older. Ignoring these mandatory interlocking thresholds leads directly to lost wealth. Mastering this arithmetic is critical for long-term financial health. These rigid mechanics also govern early-stage accumulation tools. The First Home Savings Account has strict contribution limits of $8,000 per year, up to a $40,000 lifetime cap. Because FHSA contribution room only begins to accumulate on the exact day the account is opened, delaying the start date permanently forfeits that specific contribution room. Evaluating asset location inside a TFSA, Whether contrasting a bond ETF against a broad equity ETF over 20 years, or analyzing a dividend fund case over 10 years, relies entirely on historical, backward-looking returns, not promises of future performance. Macro spending swings and shifting crypto regulations remain outside individual control, but mastering the rigid arithmetic of Canadian personal finance remains the strongest foundation for protecting long-term wealth.